Hello, and today we're going to be talking about money, banks, and Federal Reserve. First question you may have is, what exactly is money? Well, in the US, we think of the US dollar as money. Money, on the other hand, is basically any asset that people are willing and able to accept in exchange for goods and services or for payment of debt, or basically anything that performs the functions of money. Now, cash is money, but money is not just cash. An asset is basically anything of value that a person has. And if we didn't have any money, then we would do what we call barter. And bartering is basically when we would exchange a good for another good. Now, it's interesting in this case to have a conversation about why do we end up with paper money like the US dollar. So one of the basic reasons why we end up with paper money in a very basic way is because you can carry it, it's easily divisible, and it's identifiable. In other words, you can tell what is a dollar and what's not a dollar. And today there are a bunch of different ways in which you can tell, when a dollar is quote unquote real versus not real. Somewhere around the 70s, we decided to go fiat money in the US. So basically, today, what we print are these pieces of, we say paper, but it's really more like clothing, that they are approved by the government to basically be our currency in our society. Now, if we didn't have any money, then we would do what we call bartering. The biggest problem with bartering has to do with the size of units. Money is not necessary for the purpose of having an economy, functioning economy, but it is necessary to have a sort of modern economy. If you think about a process of bartering, imagine that I have a car and you have, say, loaves of bread, and that's basically what you sell, but I sell a car. Then my unit is a heck of a lot larger than your unit, and it will be very difficult for us to get together and agree on an exchange between your unit and mine. So the best way to solve that problem is to take whatever you own and turn it into an asset that we can both agree that we can exchange. And that's basically what money is. Money is the thing that we use between us to exchange in order to turn whatever value we have into a standard sort of value. Now, what exactly are the functions of money, or what can be money? So basically anything that performs these four functions in society can be considered money. Not all the books, by the way, have all four functions, but pretty much all the books will have the first three functions here. A medium of exchange, which basically means that it serves as an exchange between a seller and a buyer. A unit of account, in other words, people count their worth in money. A store of value, you can take money and put it away and save it for later. And a standard of deferred payment, in other words, somebody says, I owe you, and then they use that as a standard for deferred payment. For example, for medium of exchange, so let's say you go to Publix and you want to buy rice, then they take dollars. A unit of account is when somebody says, so how much money do you make per hour? Then you say, okay, I make this much per hour, and you say it in dollars. A store of value basically means that you can store this for later. So you can take the dollars, put it in a bag, and then eventually take them out of the bag and use them again. And then a standard of deferred payment, you can basically tell people, I owe you this much, and it will be in dollars. If you go back in time, you would notice that this was not the standard. So when people used to say, how much am I worth, or how much money do I have, usually they would talk about the amount of heads of cow that they had, the amount of land that they had, how many chickens do they have, goats. So they would start kind of like enumerating the pounds of meat that they had and things of that sort. So there wasn't like a standard for all of these. That's is basically what money provides today. Now there are two basic types of money. There is what we call commodity money. Commodity money is basically when you use a good as if it was money. And this is a case of gold, silver, stuff like tobacco, animal skins, and salt that has been used as money before. So the product itself has another independent value beyond the value of it. In other words, beyond the value printed on it. It has another independent value outside of that, so you can use it for something else. Tobacco was money in Cuba in the 17 and 1800s. We also have fiat money, which is what most countries are using today. Fiat money or fiat money is basically money that is basically paper currency, and it is authorized by the central bank to be money. So it doesn't quite have an independent value outside of what's printed on it. Another way of thinking about this is, imagine that you take a gold coin and you dip it in like black goo, and when you take it out of that black goo, you cannot identify the face that it has. Because it is a gold coin, you still know that it's gold if you know that it's gold. So it has this sort of independent value regardless of whether you can see the face or not. Fiat money doesn't really have that. If you take a $100 bill and you dip it in like black paint, then it just becomes a piece of black paper. And then that doesn't have any independent value. If it loses its characteristics, then it doesn't have any independent value. So that's what we call fiat money. The Federal Reserve System is basically the central bank in the US. And we don't like to use the word central bank because it really isn't one bank. It is a multitude of banks. As a matter of fact, we have 12 central banks in the US. That's why a more accurate name is a system. So it's called the Federal Reserve System because it's a group of banks. Now, the Federal Reserve System, we might be talking about it as the Fed. That's what a lot of people call it. Not to be confused with the Feds with an S, which is basically the FBI. The Federal Reserve System, or the Fed, is the central banking system in the U.S., which basically means that they're in charge of regulating money. I'll give you a list of functions later, but basically they're the ones who decide what are we going to use money. They designate it as legal tender. They can also print it and shred it. Now, the Federal Reserve was created in 1913 because we were having a lot of bank runs and contagion in the early 1900s. And it was created by the Federal Reserve Act, and it became effective on January 1st, 1914. I want to quickly dispel some of the So I heard a conspiracy theory once where somebody said that the Federal Reserve Act was voted by like 5 people in a dark room or something of that sort. So here is a Federal Reserve Act on Wikipedia, and here is the amount of people that voted for it and when it happened. So basically, the Federal Reserve Act was passed in the House on September 8, 1913. It was voted approved 287-85. 5 people voted present. And then in the Senate, it was approved on December 18, 1913, and passed 54-34. All right. Then it was signed into law by President Woodrow Wilson on December 23, 1914, and then it became effective on January 1st, 1914. The early 1900s was a period of a lot of uncertainty, basically. And it kind of culminated in something like this, where we had to centralize the entire monetary system. All right, now the main purpose of the Federal Reserve at the time was to be the lender of last resort. So in a very basic way, they were supposed to be the bank for the banks, and that was basically their job. Their job has really expanded over time. So it was really created again to be the bank for the banks, or what we call the lender of last resort. And over time, it has been given a lot more jobs. The Federal Reserve has 12 districts separated into 24 main branches, each one of them with a president and board members. The closest branch to the Miami area is the Miami branch of the Federal Reserve, which was created in 1975. If you want more information on the Federal Reserve, you can use the link on this PowerPoint to learn a lot more about the Federal Reserve. What I'm going to give you here are just the basics. All right, so let's talk about the basic structure of the Federal Reserve System. At the top of the Federal Reserve, we have something called the Board of Governors, or BOG for short. Now, about the Board of Governors, you need to remember that it's composed of 7 members. All of the members have to be appointed by the President of the United States, and they have to be confirmed by Congress. Now, one of the members is elected as the chairman, and that person is supposed to be basically the head of the Federal Reserve. These people serve for 14-year terms plus part of a term, and the chairman serves for 4-year terms, renewable. Now, this 14-year term plus part of a term is non-renewable. So once you serve it, you cannot be there again. All right, so let's say you become the chairman. The chairman needs to be confirmed basically by every president. It happens somewhere in the second, I think it's the second year of the presidency. So once the president is elected, it takes over for a year. Then the year right after that, sometime in February, they have to confirm the chairman of the Federal Reserve or change him. So you have a total of 7 members in the Board of Governors. They all have to be appointed by the president, confirmed by Congress. One of them becomes the chairman for 4 years. If they decide to kind of demote you and not be the chairman, then you have the choice of staying as a Board of Governors member, or a lot of them decide to basically just walk away and do something else. So this is the top of the Fed. Now, right below that, so right below the Board of Governors, we have something called the Federal Open Market Committee. Or FOMC. The Federal Open Market Committee is the actual entity that conducts monetary policy. The Federal Open Market Committee is composed of 12 total members, which include the 7 members from the Board of Governors, plus 5 presidents of other banks from the Federal Reserve. One is the president of the Bank of New York. So the president of the New York Fed, plus 4 presidents of the other Federal Reserve banks. So again, you have the 7 members on the Board of Governors from here, and then the president of the New York Fed plus 4 presidents of the other Federal Reserve districts. And I'll show you the districts in a second. This is a total of 5 presidents. Now, the 4 presidents serve in a rotational basis. President of New York is always there because he's going to be the one conducting monetary policy. And again, each one of the members has 1 vote on the meeting. They normally meet 8 times a year. Or they could do emergency meetings, such as the ones they conducted in 2008 and 2009 during that recession period, or the ones being done in the 2020 recession. All right. Now below that group of people, we have the 12 Federal Reserve banks. So we have 12 districts of the Federal Reserve. Now these districts are geographical locations basically. So we split the US into 12 different geographical areas. And then inside of those, we have 24 main branches of the Federal Reserve. And the branches are physical locations. Now, these physical locations have different purposes depending on the branch and the location and where they are. For example, the Federal Reserve Bank of Atlanta, which is the one where Miami belongs. And the Federal Reserve Bank of Atlanta is one of the main ones today in the US, clearing all transactions in the US. Now, each one of those districts has a president and a group of board members, and each one of those physical branches also has a president and a group of board members. Now, below that, you basically have the banks where you and I interact with the system. And below that, we have us. All right. Now, the Board of Governors and the Federal Open Market Committee, even though most of the people on the Federal Open Market Committee basically work on their own district, when they meet, they normally go to DC because there's a big location in DC, in the District of Columbia, for the Federal Reserve. So the meeting of the Federal Open Market Committee usually happens in DC, and the Board of Governors is usually stationed in DC. These are the group of people that basically represent the Federal Reserve. So, for example, the chairman of the Federal Reserve has to talk to Congress regularly to tell them basically how the economy is going. All right. So I hope my little drawing here helped you understand the structure of the Federal Reserve. So right here we have the different districts of the Federal Reserve. Miami belongs to District 6. Each district has a number and they have a letter. So if you look at a dollar bill, it will tell you where the currency was printed or who was the Federal Reserve that requested that printing on that US dollar. So let's see if we can read it on one of these bills. All right, so this particular bill here, for example, notice that it says B, it has a 2, all right? It also says Federal Reserve Bank of New York, okay? We'll go back to our district, notice that that is a 2, okay? So every dollar that you have out there, and you can take a dollar out of your pocket right now and read it, will have a number and a letter, and then those number and letter would be the district of the Federal Reserve that requested the printing of that particular currency. The number that you see there, that number is unique to this bill. Every bill has a unique identifier. You can think of it as a social security number for each bill. And that's how we know when currency is being copied, because there will be multiple numbers on multiple bills. There's only supposed to be one number per bill. Notice also that it says Federal Reserve note. So the Federal Reserve is the only one allowed to print US dollars. Sorry, the only one allowed to request printing of US dollars. The printing is done at the US Mint. Notice that it says here, this note is legal tender for all debt, public and private. And that's basically what makes it money in our society. All right, now this right here is a bit of a recap of what I said about the Board of Governors. So the Board of Governors has 7 members on it, appointed by the President and approved by Congress. They serve for 14 years non-renewable term plus a part of a term. One of them is appointed as a chairman for a 4-year renewable term, and they are located in Washington, D.C. We have what we call the Federal Open Market Committee, or FOMC. It's composed of 12 members, the 7 members from the Board of Governors, plus the president of the New York Fed, plus 4 presidents of the other Federal Reserve districts. Now, these people are responsible for managing what we call the money supply and deciding on monetary policy. They meet in Washington, D.C., usually 8 times a year, or when needed, or during emergencies. And their main job is to conduct what we call open market operations through the Federal Reserve Bank of New York. We'll talk about the tools of monetary policy, and the main one is open market operations. Now, the Federal Reserve has a lot of different jobs, but their biggest job is to conduct what we call monetary policy, or to manage what we call the money supply. Monetary policy are the actions that the Fed takes to manage the money supply and interest rates to pursue macroeconomic policy objectives. During the recession of 2008-2009, the Federal Reserve took extreme measures to lower interest rates in the U.S., and that's what we call monetary policy. Now, to understand policy, which is coming up in the upcoming chapters, the Federal Reserve has what we call a dual mandate, and the mandates dictate the behavior of the policy. So the 2 basic mandates are the Federal Reserve has to create price stability and maximum employment. Now, what else is the Fed supposed to do? So on a day-to-day basis, the Federal Reserve is supposed to issue currency, in other words, print money and shred it. They're also supposed to set reserve requirements on holding reserves. They lend money to banks and thrifts, and they provide for check collection and clearing. They act as a fiscal agent for the federal government, which means that they are the ones in charge of borrowing on behalf of the federal government, or executing the transaction, basically. The Treasury Department is the one that usually borrows money. They supervise banks, consumer protection, they control the money supply, and they collect economic activity and information. Now, at this point, or a little bit before, I usually like to talk about the difference between the federal government and the Federal Reserve and how come some people confuse them both. So even though the Federal Reserve represents us, they're not the federal government. It's basically a private institution that is in charge of our money supply. So most people are familiar with the structure of the U.S. federal government. We have 3 different branches. We have the executive branch. In the executive branch, you have the president plus cabinet members. We have the legislative branch. That's where you're going to see the House and the Senate. The House has 400 plus members, and the Senate has 100 members. The house depends on the size of population. This is why it's extremely important to fill out the census every decade, because the house representation of the federal government depends on the count on the census. So if you have an area that is undercounted, then it will also be underrepresented for the next decade in Congress. So it is extremely important for absolutely everyone to encourage everyone they know to fill out the census when it happens. The Senate is 2 per state. There are 50 states in the US, so there are 100 senators. Then you have the judicial branch, and this is basically the Supreme Court plus other federal courts. Alright, now there's somebody in the federal government that kind of interacts between the two, and that's the Treasury Secretary. Now, Treasury Secretary's signature is the one that you're going to see on dollar bills. So, if you look at a dollar bill right here, notice that it says Secretary of the Treasury. Okay? And then, of course, every time you print new money, it comes with a new signature from whoever the Secretary of the Treasury is. And the Treasurer as well. Alright, now again, none of this stuff is to be confused with the Federal Reserve. As a matter of fact, that's actually one of the key points in this, is that the government and money are not the same people. So these two were separated in 1913, and that was actually the point, to separate the government from money. So the Federal Reserve System, which we call the Fed, it's basically a sort of quasi-public, in many ways private organization that takes care of money in the US, while the federal government is the one that comes up with laws. Alright, so hopefully that's clear. Now these are the 3 tools of monetary policy. The tools of monetary policy are the things that the Federal Reserve uses to manage the money supply. In other words, to increase or decrease the level of interest rates through market forces. Open market operations, or OMOs, is when the Federal Reserve buys and sells mostly US Treasury bills in the open market. The second one is what we call the discount rate. The discount rate is the rate the Federal Reserve charges banks for loans from the Federal Reserve. And the third one is changes in what we call the reserve requirement, which has to do with something called the money multiplier. And we would explain that farther down this particular chapter. Now, why do we care about the behavior of the Federal Reserve? Well, the biggest reason is because the Federal Reserve, by changing monetary policy, controls something called the federal funds rate. The federal funds rate is basically the cheapest interest rate that you can get in the US. It's the sort of bottom interest rate. So I want you to think about a little bit of how this works. So when a bank is going to borrow from another bank, so when it's what we call a bank-to-bank loan, the interest rate that they charge each other is the federal funds rate. So let's call it interest rate FF for federal funds rate, okay? And that's basically the cheapest interest rate that you can get in the US most of the time. Now there's another interest rate called the discount rate. And the discount rate is part of the 3 tools of monetary policy. This is when there's a Fed to bank loan. So remember that the main job of the Fed is to be the lender of last resort. So if a bank is in monetary trouble, they would, at the end, or at the kind of like before they go bankrupt, I guess they show up to the Fed, or way before that, but just in case. So the last resort would be to kind of go to the Fed and ask for money. And this is what we call the discount rate. Now these two interest rates basically dictate every other interest rate that you and I get. The closest rate that people can get is what is called the prime rate. And the prime rate is basically the rate for people with like excellent credit. Now everybody else will get something higher than prime. So I want you to think about prime plus something. Okay, so let's come up with a hypothetical example. So let's say that these interest rates at the bottom are something like 3%. So that means that one bank can borrow from another bank at around 3%. Now imagine that somebody walks into the bank and says, hey, I want a loan, and they're excellent credit. So what would happen is the bank would tag on to these 3 something so they can make money. So let's say they tag another 3 to it. Then basically the rate that you will get as a prime person will be 6. Because you will get the 3% that they need to borrow from another bank just in case. And then you'll tag on the 3%, which is the profit that the bank wants to make. And then you end up with a 6% for you. Now, if you don't have that good credit, then you may end up with 6 plus. You end up with prime plus something. So you may end up with, say, 10% if they tag on an extra 4 to give it to you. All right. So again, this is right here is a kind of like profit to prime, and then another extra 4% tagged on to get to people with bad credit. And then if you have terrible credit, then again, it'll be another plus. Now imagine that I cut this interest rate down here to say 0. So now I lower the bottom to 0. Then what basically happens is if I tag on 3 to that, then now my prime becomes only 3. All right, and then if I tag on another 4 to that, then the one for back credit becomes 7. So basically, the way the Federal Reserve controls the interest rates is by changing, or you can think of it manipulating, the bottom interest rate down here through the 3 tools of monetary policy. So they make this bottom interest rate go down or go up. And then by doing that, the rest of the interest rates will follow. So by the same token, if instead of bringing it from 3 to 0, the bottom interest rate, if I bring it up to say 6%, then I got to tag on a 3 to get to prime. So prime will get 9. And then you got to tag on another 4 to get to the next one. So that person will get 13. All right. So this is how the Federal Reserve, in a very basic way, controls interest rates. They manipulate the bottom interest rate, also known as the federal funds rate and the discount rate. And then all the other rates follow with that bottom rate. All right. Now, what exactly do we call money? Believe it or not, there's a lot of things that are called money in the U.S. So what we do is we separate it into what we call monetary aggregates. All right, this is one of the best diagrams that I found out there about the monetary aggregates. So we have something called M0. M0 is basically currency in circulation plus currency in the vaults at the Federal Reserve. And that's something called also known as the monetary base, okay? So the monetary base is when you add the currency in circulation plus the currency in the vault. So monetary base is basically saying physical hard cash, either at the Fed or at the banks or in circulation. That's what we call the monetary base. Now M0 is currency in circulation. Then we have what we call monetary aggregates, which is sort of adding to that. So M1 is this M0 plus demand deposits and checkable deposits. So you can think of it in a basic way, checking accounts. Then you have M2. M2 is adding this plus this plus this. So we have savings deposits, multi-time deposits, retail money market deposit. And then we have M3. M3 is all of that plus this stuff is here as well. Okay? So the monetary aggregates, it's sort of our different definitions of what we call money. This is the biggest things that will be on the test. So most of the time you'll get like M1 and M2. And you need to remember the definition for those. Now this is to give you an idea of what M1 and M2 look like. So this is the M1. Again, this graph is provided by Pearson Education. Thank you very much. This right here is the amount of currency. So this is M1. And then this right here is a M2 in 2013. Now notice that M2 includes M1, which is this portion here. So this is right there in this section here. And then it also includes this other stuff. So that's how like you build the monetary aggregate. All right, right now we need to talk about something called money creation. And I see plenty of videos on YouTube about money creation, so there's plenty out there. But in any case, let's do a quick example of how banks can create money. Let's use Excel to do that. All right, so let's do a basic example of how banks can create money. Now, just a little refresher, remember the monetary base is basically currency in circulation plus reserves. Reserves is basically the same as currency, so this is all cash. Now it depends on whether it is, where it is. So if it's in your pocket or in anybody's pocket, we call it currency in circulation. If it's at the federal, the reserve vault or in the bank's vault, we call it a reserve. So a reserve is basically cash in the bank or at the Federal Reserve vault. In order for banks to create money, they have to maintain a certain level of reserve. So in other words, for banks to create accounts and to create credit, they have to maintain a certain percentage of reserves in the bank. We call that required reserves in this. And let's say that the required reserve ratio, we're going to call it lowercase r, equals 10%. Now, what is it 10% of? Well, it's 10% of the account balances. Okay, so 10% of whatever this number is. All right, so to come up with an example, let's say that Professor Choi has $1,000 in cash. It has to be cash. Okay, and I take my cash and I deposit it into the bank. So I make $1,000 cash deposit into the bank. All right. Now, as soon as my deposit enters the bank, it becomes a bank reserve. So now it becomes an actual reserve for the bank, and we got now 1,000 here on the bank. Okay, so this is a reserve that the bank has. Now, what did the bank give me when I give them $1,000 in cash? Well, they give me a bank account number. So let's say they call my bank account A101. That's my account number. Now, I go to the bank, they give me a receipt. They say, well, you got $1,000 on it. And I have $1,000 on my account. Now, if the government required the Federal Reserve, the banks to maintain 100% of your money in the bank, then basically the banks will not be able to create any credit. So loans will not exist. As a consequence of that, we need to allow the banks to maintain in the bank less than 100% of the amount of money that you and I have in the account. So they don't keep 100% of the money that we have. They use a lot of that money to loan it out to other people. And that's the process of what we call money creation. So they have to maintain in the back 10% of the account balance. So they have to make sure that they have at least 100 in the back. But that means that they have 900 left that they don't have to keep in the back. And by the way, this actual plus excess plus required basically has to add up. All right. So then imagine now that somebody wants to borrow some money. So let's say Joe goes to the bank and says, hey, I need to borrow some money. Now the bank at this point only has $900 to let him borrow. So they can create a credit card for him and say, okay, well, this is your account number, let's call it B102, and you can borrow $900. Now, what they gave you to borrow is money, but it's not really cash. I mean, when you borrow from a bank, they don't grab a bag and give it to you in cash. They give you other things that you and I use as if they were money. So the reserves haven't left the building, and the reserves are basically cash. So the bank still has 1,000 in reserve. Now, because they have two accounts, they have to make sure that they keep 1,000 for the first account. So that's this 100. But then they also got to keep 90 for the second account. Let me put that here so you understand this. Okay? So they got to keep a total of 190 for both accounts. Okay? So they got to keep 100 for the first and then 90 for the second account. So they got to maintain a total of 190 in cash in the back. That's what a reserve is. But because the actual reserves haven't left the building, believe it or not, I can still loan out more money. So now I still got about $810 that I can loan to another person. All right, so let's say now that Mary shows up and she wants to borrow some money. So I open an account for her, call it B103. And what I can loan to her right now, it's only 810. So she says, okay, to 810 or less than that, then I loan it to her. Now, because what I gave her is not really cash, then I can keep doing this. So I still have 1,000 in reserves in the back. And now I got to make sure that I maintain an extra $81 for that account that I just opened for Mary. So the number that we see down here is going to be the previous plus 81. So I got to maintain 271 in the back. But look, I still got money that I can loan out as long as my cash is not leaving the building. Now I still got 729 that I can loan out to the next person. All right. Now let me stop it somewhere on here so you understand why we call this money creation. Now the amount of actual money in this particular system is everything that people count as money. So if you're able to write a check to someone and they accept it, that's money. If you're able to pay with your debit card or your credit card, that's money for the purpose of that particular transaction. Even though credit cards are not considered money, the account behind it in many ways is money. Okay? But in general, anything that people are willing and able to accept for the purpose of transactions, and then we count wealth on it and so on, is considered money. Okay? Now when you use your credit card, the credit card itself is not considered money, but that becomes income for someone. So that's money, the account behind the scenes. Therefore, if you look at this particular place here, the amount of money that we have in the system is all of these account balances. So this is equal to that amount plus this amount plus this amount, and that is the total amount of money in this particular system right now. Now, out of that much money, how much is cash, like hardcore cash? Then the answer is only 1,000, because that's what we started this with. So that's why I said at the beginning that cash is money, but money is not just cash. A lot of what we have out there is what a lot of us are starting to refer to as e-money. So there's just numbers in the computer. Okay, so there is a lot more money in the system than there is cash in the system. Now, some of the formulas that follow up on the PowerPoint, they're basically explaining, so what is the maximum amount of money that the system can create with the current rules. And in this case, we're talking about this 10%. So the maximum amount of money that a system can create in general is the amount of cash that you have in the system multiplied times what we call the money multiplier. Now the money multiplier that we're going to be using here is the simple money multiplier, because it's a slightly more complex than this. But the simple money multiplier, and I believe most books use something like lowercase m for this, is 1 divided by the reserve ratio in decimals. So the maximum amount of money that I can create in this particular system is equal to the original amount of cash that I had in the system, which is 1,000, and then I multiply that times 1 divided by the reserve ratio, which is 0.10. Alright, so this portion here is the money multiplier. This portion here is the amount of cash in the system. So the maximum amount of cash that I can have in the system now becomes 1,000 times 10. If you do 1 divided by 0.10, it will give you 10. Or the maximum amount of money that you can create in this particular system is $10,000. And now notice how this makes sense, because basically if I'm required to keep 10% of whatever I create in cash in the back, then that's what these 1,000 are. These 1,000 are 10% of 10,000. Now in this particular system, which is purely theoretical, you will not be able to withdraw any sort of cash, because then the bank will go illiquid and it would not comply with Federal Reserve rules. So most banks don't keep only 10% in the bank, they keep more than 10%. And it's just to make sure that they're not breaking any Federal Reserve rules at any point in time. All right, so again, these are the formulas that you see right down here. Reserve ratio in the US today depends on the type of bank. So let's go look at that. All right, so this is a website from the Board of Governors. Oh, wow. So this is something that I did not notice up until now. In the announcement of March 15, 2020, the Federal Reserve also removed the Federal Reserve. It removed the reserve ratio for all institutions. So right now the reserve ratio is 0, as you can see, which means that the banks can create unlimited amounts of money. Now the normal reserve ratio is 10% for large institutions, 3% for medium size, and 0 for small. That's what we had before. So this right here explains what was happening prior to effective date of March 26, 2020. Okay. So all right, we did the example of money creation already. Now, one of the things that we need to make people understand is that printing too much money leads to inflation, which is the reason why you don't want to print too much money. Now, this relationship is what we call the quantity theory of money. And the quantity theory of money basically says that money times velocity equals price times output. M here is money supply, V is velocity. Velocity is the average number of times money exchanged hands. Price is inflation using the GDP deflator, and Y is the output level using GDP. All right, so let's think about that relationship. So the quantity theory of money, or QTM, basically says that money times velocity is price times output. All right. So let's say that we do sort of hypothetical to this economy. So imagine that I decide to increase the amount of money in the system. Then what this formula basically says is that there are two things that need to happen in order for the equality to be maintained. Either something on this side has to go up, or velocity has to go down in order to maintain that equality sign. Now, for simplicity purposes right now, imagine that I maintain velocity the same. So imagine that velocity does not change, which is not true, by the way. Velocity seems to be cyclical. So it goes up. Velocity seems to go up during expansions and down during recessions. All right. In any case, so let's say velocity is constant. Then what this formula is basically saying is that if I print more money, then it either ends up creating inflation or creating output. Now, output is something that you don't really control in the market system. Output is whatever output is, or whatever companies are producing. So they're producing more, there'll be more output. They're producing less, there'll be less output. So if your economy is, say, growing a lot, then you might be able to print a lot. But if your economy is growing by a little, then you won't be able to print too much money. The more money you print, if output stays at a particular level, then the more inflation you're going to incur, the higher the CPI will go. And that's basically the idea. So the quantity theory of money creates a relationship between money, output, and price level. Now, to illustrate that, let's talk about this problem of high inflation in Argentina in the 1980s. So in the 1980s, somewhere in 1981, notice the light green is money growth and the dark green is inflation. So notice that whenever they printed more money, they ended up with a higher level of inflation. Whenever they printed less money, they ended up with a lower level of inflation. Then they printed a heck of a lot more money. Then you end up with a heck of a lot more inflation. Then they print a heck of a lot less money, and they end up with less inflation. Notice also, by the way, that the kind of missing area here is over here. So notice how the printing of money and the inflation rate kind of go hand in hand. Is what this is showing. Notice also, by the way, that inflation in Argentina was ridiculous. In 1989, that number is 3,000%. 3,000%. Right? In the 1990s, they kind of get it more quote unquote under control. So they drop the printing of money down to about 50% of money supply, and then inflation drops to about 20 something. And then notice that as they kind of progressively printed less money, then inflation kind of went flat. Now, the Federal Reserve is integral in solving recessions. So during the financial crisis in 2007-2009, the Federal Reserve took a lot of steps to basically open up the credit system. And in 2009, I don't know if you know this, but Ben Bernanke was Person of the Year. And Ben Bernanke was the chairman of the Federal Reserve at the time. All right. So this is an article for the Person of the Year of 2009 for Time Magazine, and that person that you see there was the chairman of the Federal Reserve at the time. All right, now if you're interested in knowing who's the chairman of the Federal Reserve now, then all you have to do is put chairman of the Federal Reserve. And Jerome Powell is the chairman of the Federal Reserve as of March 2020. The previous chairman of the Federal Reserve, his name was Janet Yellen, and the previous chairman of the Federal Reserve was Ben Bernanke, and before Ben Bernanke we had Alan Greenspan. Peter Navarro was not a chairman of the Federal Reserve. Neither is Tim Mnuchin. Tim Mnuchin is the Treasury Secretary under the Trump administration. All right, and that concludes our chapter on money. Talk to you guys later.